So I thought I might take a few minutes to talk about one of our favourite subjects in the mortgage market today, swap rates. And in particular, talk about, can you use a swap rate, the swap curve, to predict what mortgage rates will do in the future? So first of all, what is the swap rate, swap curve? Very simply, it is the cost of buying money from a bank for a certain period of time, 2 years, 3 years, 5 years, etc., on any particular day. And the way it's formed or set is largely to do with the economics and the fundamentals within the market, but more and more so the market sentiment and the confidence and certainty the market has. And this presents a problem for us to try and predict mortgage rates. So let's just go back 12 months ago and let's use the 2-year and the 5-year swap curve to indicate what would be the cost of money. Well, 12 months ago, 2-year was around 190 basis points. 5-year was around 180 basis points. And what we know today, 12 months on, it's doubled, probably more than doubled, both for 2 and the 5-year. So really, very little use whatsoever, given the market circumstances. So now let's think about the marketplace today, as we film this today. So right now, the 2-year swap rate is around 405. So what you can tell, and what is highly correlated, is what would be a mortgage rate today. And you can estimate that to be 50 or 60 basis points above that swap rate, because that's not an unusual margin for a lender to take above a swap rate. Lots of market circumstances depending. So that becomes very useful and a very good indicator for what a rate should be over a very short window of time. However, let's just add some more complexity to this, unfortunately. Today, as I said, it was 405. 3 weeks ago, it was 450 basis points. And 3 weeks before that, 375 basis points. Now that is a lot of volatility. So how can you take that to your customers and advise them on what is the likelihood of a future rate? Well, simply, it's just extremely difficult to do. So what do I see for this? What can mortgage advisors do about this in these uncertain times? Well, in my view, it's about trying to advise your customer in the here and now, because it's really the only thing you can do. But probably it's about the product they're buying or the product you're advising as much as the best rate that you can find them. The fact that you give them certainty in a 5 or 2 year, or you have no ERCs on a tracker, and whatever's right for that customer. The product today is probably equally as important as the rate that you're going to advise on. And going forward, certainly for 2023, that's probably going to remain the case.